Well, investors may want to consider increasing their exposure to cash with stocks at all-time highs. It's an asset Mike Contopoulos likes right now. He is the head of multi-asset macro investing at Janus Henderson Investors. Michael, great to see you.
Nice to see you as well.
How high are you in cash, and how unusual is that for you?
We're about 7% cash across our portfolios. That's a little unusual for us. I mean, equity markets tend to go up, as we all know, and so you don't want to be underinvested per se, but I think during these times where you have so much uncertainty around what's going on with Iran, what's going on with inflation, the potential for rate volatility, which I think could be quite large, I don't think you want to be overexposed either to the equity market here. So what we did in our portfolios is we raised cash, but we didn't change the overall structure of the portfolio. So it's not like we added defensive stocks. We didn't go and buy staples, healthcare, and utilities. We actually still continue to have a cyclical bent, but we just raised cash to have on the sidelines in case there's a drop in the market to be a little bit more opportunistic.
In terms of how we should think, though, I understand that the overall construction remains the same, but it's got to come from somewhere. So walk us through where it comes from.
It does have to come through somewhere. So the way that our portfolio is currently positioned is we're overweight international markets, underweight the U.S. We brought down basically Europe and Japan, but we also brought down value in the U.S. And I think that's the right call. The expression is, again, more about volatility and being prepared for higher volatility than it is about crawling into the fetal position under your desk and being scared of what's out there. The macro environment's actually quite strong. So I think this is more about waiting out the storm.
What does bond volatility look like? And we got up north of 460. The market did not like that. What does it look like to you?
Guy, I've been saying this for a while as a view. I think the 10-year is going higher. I think that you could see real serious gaps in the 10, and I think you could easily approach 5%. And, if Chair Warsh were to somehow convince the committee, which I don't think he'll do, in fairness, but if he were to convince the committee to cut rates, I think you could gap very quickly to 5.5%. I mean, the economy's strong. Earnings growth we're seeing is fantastic. There's no lack of credit availability, which is the whole point of tight monetary policy. And so if the Fed cuts rates into inflation that's going up and growth that's strong, then we're going to see 5+ on the 10-year. If they keep where they are or even hike, which they could do, I think you're going to be range bound between that 4.4 and 4.6 range.
So does any of your cash allocation, is any of that because cash is actually paying something right now as opposed to just a, dry powder?
100%. I mean, the calculus was we can sit there and earn 5% or roughly 5% in cash and, again, have that dry powder and put it to work at some point, or we can own a highly volatile equity market or fixed income market that could see some price loss as rates go higher. And so absolutely, Karen, the 5% or 4.5% cash level is definitely reasonably attractive here.
Michael, you just mentioned that you're moving more towards a cyclical sort of bent. What does that look like to you? Like, what would be one sector that would start to think a bit more cyclical, less secular, that we should be keeping an eye on?
So we've liked industrials for a little bit. If you actually look over the last 10 years even, small and mid-cap American industrial companies have outperformed the NASDAQ, which is a pretty crazy stat. So we continue to like industrials. It's been somewhat of a mainstay in our portfolios when we think, there's some cyclicality and some positive momentum in earnings. Materials is another space. We've been overweight emerging markets ex-China this year, which has obviously been a nice call. Now, you got a little bit of that sort of chip momentum in play there, but the actual underlying fundamentals for emerging markets, excluding China, are quite good. And so those are three cyclical areas of the world and at a sector level that we like.
I like EM too. I still don't believe EM can do what it's doing if rates go higher, and that is something you're concerned. And what I hear, you haven't really quite said it, but it's asymmetric risk in the rates market here, no?
I do think it's asymmetric risk. I think there's a world in which EM does okay with higher rates. I mean, it's obviously done well as rates have gone from about 390 to 460, and emerging markets ex-China has done quite well. So I think there is a world in which it does well. Remember, much of emerging markets is exposed to the commodity complex, certainly the producers from LATAM. And so if those rates are being driven by higher commodity prices, I mean, you could see that feed through and see some positive catalyst for emerging markets or parts of emerging markets.
Yep.